Okay, so in this video, what we'll be considering would be to calculate how to calculate the unrealized profit if you are selling a non-current asset, as in the parent is selling it to the subsidiary or the subsidiary is selling it to the parent. In the previous video, which I covered up with you, we were talked about in case if there has been a sale of inventory, okay? But now in this video, what we are trying to discuss is in case if a non-current asset like a property, plant and equipment has been sold from parent to the subsidiary or vice versa, that's from subsidiary to the parent. Okay, basically the concept remains same as far as the entries are concerned. That will pretty much remain same. Okay, so in case if the parent is the seller, the entry what you will do would be you will debit your group retained earnings. Okay, and you will credit your non-current asset in that case. Okay, and I have already discussed this thing in the previous video with you guys, that when you're talking about the group retained earnings, actually this means that you have to adjust it from working number 5. Okay, so if the parent is the seller, then the parent has the profits, and the parent is has the profits, and then you need to adjust it from the overall group retained earnings of the parent. But likewise, if the subsidiary is the seller, then the profit is actually with the subsidiary, and in that case then the profit is not belongs some to the controlling part and some to the non-controlling part. So if the subsidiary is the seller, then we just don't need to debit your group retained earnings, but what we also have to debit is our NCI. Okay, and we will credit the same non-current asset. So the non-current asset will be credited in both the cases, but the difference is what will be the debit. So if the parent is the seller, in that case, it will only be from the group retained earning, which is working number 5. But in case if the subsidiary is the seller, so you have to adjust it from working number 2, which is the net assets of adjust it from working 2, which is the net assets of the subsidiary at the reporting date. So automatically it will flow through your group retained earning calculation while you're taking your share in the post acquisition retained earnings. That's the parent share, and as well as for the NCI valuation, which is obviously after deducting this value, you will get the total net assets of the subsidiary at the reporting date on which you apply the NCI percentage, right? So that's what we talked about, that how we should treat it in the financial statements. But the question remains that how are you supposed to calculate the unrealized profit in case if this would have been a sale of a non-current asset. So for this, I have a question over here for you. It's illustration number 5 from the Kaplan study text. It says P acquired 80% of subsidiary a number of years ago. P transferred an item of plant to S for 6,000 on 1st of January. Okay. So right now we are at the date of disposal, right? Uh, at the date of disposal. Okay. So it has been sold for 6,000. The plant originally cost parent 10,000 and had an original useful life of 5 years when purchased 3 years ago. So basically, at the date of disposal, you can see that cost of this asset is 10,000. The life of the asset is five useful years. So the depreciation that will be charged per annum will be 2,000, which is 10,000 divided by 5 years. So I'm going to get 2,000, right? 1 second. 10,000 divided by 5 years. So it's 2,000. Well, so the net book value of this asset at your date of disposal would have been 4,000 at date of disposal, which is 1st of January 20, what is it? 21. Yeah, 1st of January 21, uh, 2001, it would have been 4,000 because 10,000 minus 6,000, right? It has been 3 years. So accumulated depreciation would have been 6,000 because 3 years have been passed, so that's a total of 6,000, and the net book value would have been 4,000. Okay. Now we are assuming that this asset was not being sold to the subsidiary, right? Then what would have been the value of the asset by the end of 31st of December 2001? So in that case, the net book value at the date of reporting, which is at the date of year end, would have been another 2000 depreciation. So this would have been at 2000, right? Because it's like total of 4 years. So every year you're charging a depreciation of 2000. So in 4 years, there would have been a total depreciation of 8, and the net book value of this asset in the books of parent, if it would have not been sold, would have been 2000. So 10,000 minus 8,000, you would have got 2,000. But now the fact is that it has been sold to the subsidiary for 6,000. Okay. So assume now that the asset has been sold to the subsidiary at 1st of January 2001 for 6,000. So if that would have been the case, this asset in the books of subsidiary would have been at 6,000, and the remaining life for this asset was 2 years if it would have been disposed at 1st of January 2001, right? So 6,000 divided by 2 years, in that case, the subsidiary would have charged a depreciation of 3,000. Okay. And the value of this asset, if sold to the subsidiary, would have been 3,000, because you see the cost to the subsidiary for this asset was 6,000, but then the subsidiary charged a depreciation of 3,000 for the current year 2001, and the net book value of this asset in the books of subsidiary would have been 3,000, right? And the value of this asset, if sold to the subsidiary, would have been 3,000 by the 31st of December 2001. So now what's the subsidiary doing is that it's kind of overstating the asset, because if this asset would have been in the books of parent, it would have been 2,000. But here, net book value. Okay. So this would have been at 2,000, but in the books of subsidy, the same asset has been overstated by 1,000, and it's at a valuation of 3,000. So this, how much you have overstated it, is basically considered to be as your unrealized profit. So that's one way. That was the explanation to make you understand that how we have overstated the value of the asset. So in case if the parent would have stood with the asset and have not sold it to the subsidiary, it would have been in their books at 2,000, but the same asset in the books of subsidiary is at 3,000. Both of them are one company. We represent them as a group when we are preparing the consolidated balance sheet. Therefore, we need to reduce this 1,000, the overstatement of the non-current asset, right? So in this case, because the parent is the seller, I'm just going to say group retain earnings debit by 1,000 and credit non-current asset by 1,000. But on the other hand, if the subsidiary would have been the seller, I would have said 1,000 credit non-current asset. But from that 1,800 would have been recorded in the group retain earnings, and 200 would have been a share for the NCI. Okay, so that's the difference. Anyways, but now I won't ask you to do this such a long way while you're doing the exam question. If that makes sense for you, please suit yourself. But I do have a very short formula for you guys, which is if you want to calculate the unrealized profit on the sale of non-current asset, you have to take the profit on disposal, okay, minus the excess depreciation which is being charged. So if you look up at the profit on disposal, so this is the formula for you over here. Okay. Like I gave you the formula for inventory, this is the formula for non-current asset. Now, profit on disposal over here is 2,000, because if you remember that when we were selling it, Okay, the net book value at the date of disposal was 4,000 and we sold to the subsidiary for 6,000. So what we made is a profit of 2,000. That's one part. But we were charging a depreciation of 2,000 every year. The subsidiary is charging a depreciation of 3,000 every year. So there has been an excess depreciation of 1,000 being charged. So net, this is also 1,000, which is exactly the same 1,000 which I did through this explanation. That you can see that if the asset would have been in the parent's book, it would have been at 2,000. But that same asset, if it has been transferred to the subsidiary, the same asset in their books is at 3,000. So we did an adjustment of 1,000. But this is actually a very shortcut to find out the unrealized profit on the sale of non-current asset, in which you take the profit on disposal, either the parent is selling or the subsidiary is selling, and then you subtract the excess depreciation being charged. Okay, excess depreciation being charged on the asset. Now, while you're consolidating your assets in the non-current asset in the balance sheet, here that's the formula for you. Okay, so you will take your parent property, plant and equipment. You will add your subsidiary plant and equipment. You will add any fair value adjustment if they have been more than the carrying value. So this thing can also be below. I mean, it can also be negative in case if there has been a reduction from the carrying value to the fair value, right? But normally, what we have seen in the past paper, it's actually that the fair value is more than the carrying value. So if that's the case, you add, but in case if the fair value has reduced from the carrying value, then you have to subtract. Likewise, for excess depreciation, what you simply do is that you deduct, and but in case if there is a extra depreciation, less depreciation, then that will actually increase the value of the asset. So excess depreciation or reduced depreciation. This is basically what is being a part of your fair value adjustment. So fair value adjustments are done net of your depreciation part. Okay, so that's one thing. But then from there you can minus unrealized profit, right, on sale of PPE from parent to subsidiary, or it could be from subsidiary to parent in both the cases, right? So that unrealized profit would also be subtracted after the fair value adjustment, and you will get the consolidated PPE, which will be recorded in your statement of financial position. So consolidated statement of financial position. Yeah. I hope that's clear. Thank you very much. If you have any question, please feel free to ask me. You can like, share, and subscribe. Thank you.